Hi guys, so this lesson is for CMA Part 1. Lesson 3 is about assets and Section 2 is about accounts receivables. For the outline of this lesson, first I'm going to discuss the concept of accounts receivables. Second, I'm going to talk about the concept of contra receivable accounts. And by the way, we have two contra receivable accounts. These are allowance for doubtful accounts and allowance for customers' right of sales return. So what do we mean by contra receivable accounts? So in layman's term, these are accounts which are simply deducted from the accounts receivable balance in order to arrive at the NRV. So later, I'll dive deep into each one of these. Third, I'm going to talk about the calculation of bad debts. So we have two approaches. Basically, these are first, income statement approach, or other name for this is the percentage of sales. Second is the balance sheet approach, and another name of this is percentage of receivables. Fourth, I'm going to talk about the concept of write-off of receivables. And lastly, I'm going to talk about the concept of factoring of receivables. So first, let's talk about the concept of accounts receivables. So accounts receivables, which is also termed as trade receivables. So these are amount of money owed to a firm, entity, company by its customers for goods or services delivered or used but not yet paid for by the customers. So for instance, a company has sold merchandise to its customer which is on credit. So here, the merchandise has already been transferred to the customer and the customer has already, for example, has taken home these merchandise. Therefore, a company has already the right to receive the payment for the sale of the merchandise. In some cases, some companies grant credit to their customers. So the company agrees that payment shall be made or collection shall be made in the later period. As a consequence, on the company's books or in its general ledger account, the company records receivables from the customers for the merchandise already transferred to the customer. So the classification of this, more often than not, a company grants what we call a credit term. So for example, the customer is given the period in which the customer can pay, say, within 60 days or within 90 days. And thus, more often than not, the receivables are expected to be collected within 1 year or within the normal operating cycle of a business. As such, the usual classification of receivables is current asset. Okay, so how do we report the account receivables in the balance sheet? So account receivables are usually reported at net realizable value or NRV. So how do we compute NRV? So NRV is simply arrived at by deducting allowances from the gross amount of accounts receivables. Okay, so it's simply NRV is equal to accounts receivable minus allowances. So what are these allowances? So some of the examples, we have allowance for uncollectible accounts and allowance for sales returns. So these allowances are also what we call contra receivable accounts, meaning these are deducted from the gross amount of receivables. Now let's dive deep into further discussion for the contra receivable accounts. So as mentioned earlier, we have two contra receivable accounts for accounts receivable. So these are allowance for doubtful accounts and allowance for sales return. So first, let's talk about allowance for doubtful accounts or ADA. Okay, so other terms for allowance for doubtful accounts, we have allowance for bad debts or allowance for uncollectible accounts. So what do we mean by this? So these are portion of receivables that are expected to be uncollectible. As such, we provide allowances to the gross amount of accounts receivables. Okay, so we have two methods in measuring bad debts. So as mentioned earlier, we have income statement method and balance sheet method. So other name for income statement method is percentage of sales. So that's why income statement, because sales is usually found in the income statement. The second method is balance sheet method, or another name for this is percentage of receivables. So the reason why it's called balance sheet method, because our basis for computation is the receivables, which is found in the balance sheet. So let's have here an example. For the first method, percentage of sales or income statement method. So the problem says, first, gross accounts receivables amounts to 500,000 US dollars. And then we have allowance for doubtful accounts or add up, beginning balance. So for example, if the beginning of the period is as at January 1, the balance of the allowance for doubtful accounts is 10,000 US dollars. And then sales and credit for the year is 1 million US dollars. And then we have here the accounting policy of the company is to provide allowance which is equal to 2% of credit sales. Okay, so here it is already given that the allowance should be 2% of credit sales. So the solution here is we simply multiply 1 million US dollars by the 2%. Okay? So the journal entry to record the recognition of bad debt expense and allowance for doubtful accounts, we simply debit bad debt expense of 20,000 US dollars and we credit allowance for bad debts of 20,000 US dollars. So I assume that you already have a background in terms of the dual entry method of accounting, right? So we have a debit side and we have a credit side. Okay, so here the debit side, bad debt expense, is an income statement account. And the credit side, allowance for bad debts, this is the contra receivable accounts which is being deducted from the accounts receivable in order to arrive at the net realizable value of the accounts receivable. So the reason why this is called percentage of sales method, because we multiply the 2% by the credit sales. So actually what we get here in multiplying the percentage against the credit sales is the bad debt expense during the period. This is opposite to the second method which I will discuss later, because what we will compute later is the ending balance of the allowance for doubtful accounts. So please take note of this because this is very important in terms of the computation of the allowance and bad debt. So now if we are asked about the ending balances after the allowance or after booking the adjustment, the net AR or the net realizable value of AR is equal to 480 US dollars, which is computed by simply deducting the ending balance of allowance, which is 20,000 US dollars against the gross amount of accounts receivables. Here, so the net realizable value of account receivable is 480,000 US dollars, which is computed by deducting 20,000 US dollars against 500,000. Okay, so the total ending balance of the allowance for doubtful accounts is 30,000 US dollars. So if you look at the left side here, we have the beginning balance of allowance, which is 10,000 US dollars. And then we simply add the bad debt expense during the period, which is 20,000 US dollars. Hence, we get the ending balance of allowance, which is 30,000 US dollars. Okay? So now let's go to the second method of the computation of bad debt expense, which is the percentage of receivables or the balance sheet method. So here, we have the same problem. So gross accounts receivable is equal to 500,000 US dollars. Allowance for doubtful accounts as at beginning of the period is 10,000 US dollars and sales and credit is 1 million US dollars. So the main difference here is the accounting policy, which is already 5% of accounts receivable. So if you go back to the first approach, you can see here that the computation is 2% of credit sales. So this is income statement method. In this second approach, our computation is 5% of accounts receivable. That's why this is now a balance sheet method. In here, you will note that when we compute 5% of accounts receivable, so solution number 1, we actually arrive at the ending balance of the allowance. That is, accounts receivable of 500,000 multiplied by 5%, that is 25,000 US dollars. So this is already the ending balance of the allowance for doubtful accounts. So this is as opposed to the first method or first approach wherein when we compute 2% of sales, what we get is actually the bad debt expense for the period. Here, it's different. When we compute 5% of accounts receivable, what we get is the ending balance of the allowance. So now what we do in order to get the bad debt expense, we need to squeeze the amount by simply deducting the ending balance, the beginning balance of ADA against the computed ending balance of the ADA. So here we have, take note, in the problem we have a beginning balance of the allowance, which is 10,000 US dollars, and then we computed for the ending balance of allowance, which is 25,000 US dollars. So the formula actually is beginning balance of allowance plus bad debt expense during the period, and we get the ending balance of allowance. Since we already have two known variables, which is the beginning balance of ADA and ending balance of ADA, what is missing now is the bad debt expense, correct? So we just simply squeeze it, 25,000 less 10,000, then we get 15,000 of bad debt expense, okay? So that is simply the main difference. Again, under the first method, income statement method or percentage of sales, when we multiply the percentage against the sales, what we get is the bad debt expense for the period. On the other hand, under the second approach or balance sheet approach or percentage of accounts receivable approach, when we multiply the percentage against the gross receivable amount, what we actually get is the ending balance of ADA, and then we squeeze the amount by deducting the beginning balance of ADA against the ending balance of ADA in order to arrive at the bad debt expense during the period. So please take note of that. It's very. So the journal entry to recognize bad debt expense and allowance for doubtful accounts, we simply debit bad debt expense of 15,000 US dollars and we credit allowance for bad debts of 15,000 US dollars. Now, when we are asked about the carrying amount or the NRV of accounts receivable, we simply deduct the ending balance of ADA, which we have computed under solution 1, 25,000 US dollars. We deduct this against the gross amount of receivables, which is 500,000 US dollars, and we get the NRV of receivables, which is 475,000 US dollars. Now, when we are asked about the ending balance of ADA, that is already computed under solution 1, 25,000 US dollars. So we simply add here the beginning balance of the ADA or allowance, 10,000 US dollars, plus the bad debt expense during the period, 15,000 US dollars, so that we get 25,000 US dollars. Now, for the bad debt expense, we have computed this in solution number 2. We simply squeeze the amount. Hence, the bad debt expense is 15,000 US dollars. Okay, so the second country receivable account is allowance for customer's right of sales return. So these are allowances made for return of merchandise because of various reasons. For example, if there are damaged products or in case the order is wrong because of it's either the fault of the customer or the fault of the company. So basically here, the company recognizes allowances for possible or expected sales return. So what is the entry here? So we have here sample problem. During the month of April, sales of company X amounts to 100,000 US dollars. Estimated total returns is 2% of sales. So the solution here is, in order to get the expected amount of allowance, we simply multiply the sales for the month, that is 100,000 US dollars, against a percentage, which is 2% of sales. Then we get 2,000 US dollars. And then the journal entry to recognize the revenue from a sale. So we debit cash or account receivable, 100,000 US dollars, and then credit sales, 100,000 US dollars. Second, for the journal entry to recognize the allowance for sales returns, here we debit sales returns by 2,000 US dollars, which we have computed earlier, and we credit allowance for sales returns, which is 2,000 US dollars. Now, for the sales returns, 2,000, this is actually a contra sale account. So basically, when we are asked about how much is the net sales for the period, the answer there is 98,000 US dollars, and that is computed by sales less sales return, or in this problem, 100,000 US dollars less 2,000 US dollars, we get the net sales for the period, which is 98,000 US dollars. So in this problem, if we are asked how much is the net realizable value of receivables, the answer is also 98,000 US dollars. We simply deduct the allowance for sales returns, which is $2,000, against the gross amount of receivables, which is 100,000 US dollars, and we get the NRV, which is And we get the NRV, or net realizable value of the receivables, which is 98,000 US dollars. So now let me talk about the concept of write-off of receivables. Okay, so this simply means the elimination of the amount of uncollectible receivables and the related allowance for doubtful accounts which has been previously recognized. So there are instances when the company is not able to collect the amounts due to it from the customers. So for example, if the customers are bad creditors, so the customers are not paying for such a long period of time, right? So there's no point in recognizing their said receivable if there's there's low probability of collecting these receivables since it's been so long. So what the company does, they actually write off these receivables, which is in accordance with the standards that receivables should be carried at net realizable value. So the amount that is realizable from collections from its customers. Okay. So the journal entry to record this is to simply debit allowance for uncollectible accounts and to credit accounts receivables. So here, as you can see, we debit the allowance and we credit the gross amount of receivables. So what is the impact of this? There is no impact on income statement since we don't see here any income statement accounts. So both the allowance and accounts receivables are balance sheet accounts. Second point here, there is no effect or impact on the carrying amount of accounts receivable. So if you can notice here, we deduct or we reduce the balance of account receivables. We also reduce the balance of the allowance. So in effect, there is actually no effect. So zero impact because we reduce both balances. Third is there's also no effect or no impact on the working capital. So what do we mean by working capital? That is simply current assets less current liabilities. So we are deducting both the gross amount of receivables and the contra receivable account. Hence, there's no actually impact in the overall working capital. So in some cases, customers subsequently pay the receivables which has previously been written off. So there are rare cases when the company does not collect for a long time from its customers and hence the company has written off such receivable, but then a customer subsequently pays. So what happens here is the journal entry to record this is to debit cash and to credit allowance for uncollectible accounts. So there is no effect on bad debt expense. As you can see here, there's no entry to record bad debt expense. So we have here the formula for reconciliation of account receivable and allowance for doubtful accounts after taking effect all the credit sales, collections, recognition of allowances, and including the write-off. So for the accounts receivable, how do we compute the ending balance of accounts receivable? So first, we start with the beginning balance of accounts receivable during the period. And then we add all those sales which are made on credit. Because typically, sales can be divided into two. Cash sales, or meaning sales wherein customers have paid cash. Another is credit sales, wherein customers have not paid in cash. So we simply add here the credit sales. And then we deduct the cash collections on credit sales. So we don't deduct here the cash collections from cash sales because in the first place, we have not added the related receivable on this. We only deduct the cash collections related on the credit sales. It's very important, otherwise you'll be wrong in the computation. And then we also deduct the account receivable written off. So remember in the journal entry that we made earlier for the recording of write-off, we debit the allowance and we credit the receivable. So here, in order to arrive at the ending balance of account receivable, we simply deduct the gross amount of account receivable written off. And then when we compute this, we arrive at the ending balance of accounts receivable. Second, how do we compute for the allowance for uncollectible accounts? So we begin with the beginning balance of the allowance for uncollectible accounts, and then we add the bad debt expense recognized. So if you remember earlier, the journal entry to record the bad debt expense, we debit bad debt expense, we credit allowance for uncollectible accounts. Take note that the normal balance of the allowance is credit side. If we have entries wherein allowance for uncollectible accounts is credited, it means this is an addition to the balance of allowance, okay? So normal balance of accounts receivable is debit side. Normal balance of allowances is credit side since this is a contra receivable account. Okay, and then we deduct the accounts receivable written off. So remember the journal entry to record the accounts receivable write-off, we simply debit the allowance and we credit account receivable. And since we're saying that the normal balance of allowance is credit, when we debit the allowance, it means we reduce the allowance. Hence, the impact of account receivable write-off is a reduction to the allowance account. And then we add the collection of accounts receivable already written off. So remember in the entry earlier, when we collect AR, which has been previously written off, the entry is to debit cash and credit allowance. So since the normal balance of allowance is a credit side, when we credit it, it means it's an addition to the allowance account. Hence, when we complete this, we arrive at the ending balance of the allowance for uncollectible accounts. Now, let me discuss to you the concept of factoring of receivables. So factoring of receivables or factoring of accounts receivables simply means a transfer of receivables by a company to a third party, which we also call the factor. So here, in the factoring of receivables, the factor collects payment on the receivables from the company's customers. So in other words, if I'm a company, I have a receivable from a customer, I simply transfer this receivable to another party, which is the factor, and then the factor will collect on my behalf from my customers. Okay? So what are the reasons for factoring of receivables? So we have 3 reasons here. So one reason is to speed up collection. So more often than not, factors, financial institutions or other parties wherein they have more efficient process of collection or more efficient collection process. Companies which are unable to collect, they actually transfer these receivables to a third party to speed up the collection since the factor actually pays in advance to the company for the transferred receivables. Second is bad debts are eliminated from the books. So this is the case for factoring without recourse. So later I'll discuss the 2 cases of factoring. Third is to eliminate credit department. So as I've said earlier, more often than not, factors are more efficient in terms of collection process. So I have mentioned earlier there are 2 types of factoring of accounts receivable. First type is the factoring without recourse and second type is factoring with recourse. So let's dive deep into each one of this. So first one, when we say factoring without recourse, so this transaction is actually a sale transaction. Why? Why is this so? Simply because the factor or the third party assumes the risk and rewards of collection. So it's as if I'm the company, I transferred my receivable to a factor, the third party, it's actually a permanent transfer. It's like a sale because I have transferred the risk and rewards of collection, meaning I don't have the responsibility for collecting the payments from the customers. It is now the responsibility of the factor for chasing the customers for their payments. So as a result of this, since I don't have the responsibility for collection, I've already transferred it to the factor. Receivables are not reported in my books or in the company's books. Okay? On the other hand, when we say with recourse, it simply means that this is the opposite of the first one. So it's not a sale transaction. So transaction is simply a secured borrowing with a pledge. So here, you transfer the receivable. So if I'm the company, it's my receivable. I transferred it to the factor. I get money from the factors to speed up the collection, right? However, I'm still responsible for chasing my customers for collection process. It's as if I just borrowed from the factor, from the third party, and the receivable here serves as the security for the amount I borrowed from the factor. So it's like a pledge. So I pledged my receivables. It's like the third party or the factor allowed me to borrow money from them. And as a consequence, I have pledged my receivables that I will be able to pay them the amount I borrowed from them through collection of my receivables. But I'm still the one who is responsible for collecting payments from my customers. So here, the seller may be required to make payments to the factors. It's just as if it's a loan. Okay, it's a loan and I pledged my accounts receivable. So as a company, once I collect the payments from my customers, I need to pay back the amount I borrowed from the factor. As a consequence, the receivable is still reported in the company or the seller's books and must recognize a liability for cash received from the factor. So here, factoring with recourse, this is the opposite of the factoring without recourse, because in factoring without recourse, the company totally eliminates the receivables. However, it does not recognize any liability on its books. Under the second method here, with recourse, the company still recognizes a receivables on its books. However, it recognizes a liability to the factor for the amounts received from the factor. It's like a borrowing. So let's have here an example. So the problem goes, sales for the month is 100,000 US dollars. The factor advance is 90% of receivables, which is after 3% of factor fee and interest. And the third point, factor fee is 3%. And then 4-point interest rate is 15% on all cash advance to a transferor. And then credit terms are not 30 days. So how do we compute this? So let's analyze each point. So the amount of receivables here is equal to 100,000, which is equal to the sales for the month. So let's assume that this 100,000 US dollars is all sales on credit. Okay, so here it's all receivables. So here, it means the factor advance. The factor will provide the company 90% of receivables, of course, after deducting 3% factor fee and interest, meaning the factor will withhold 10% of the gross amount of receivables. So here, we deduct 10% reserve, which is 10% of 100,000 US dollars is 10,000 US dollars, right? And then, third point, we deduct 3% of factor's fee. So, meaning, factor actually charges some charges or fees for the factoring services. So, it's 3%. Here, if you can notice, the factor advance and the factor fee, these are all based on the gross amount of receivables, which is 100,000 US dollars. So, if in case their problem is silent, we should follow this. Base it on the gross amount of receivables. So 100,000 US dollars multiplied by 3%, we get 3,000 US dollars. And then we deduct the factor's fee and the reserve against the gross amount of receivables. We get 87,000 US dollars, which is equal to the amount accruing to the transfer. And then we compute for the interest for 30 days, and that is 5%, which is usually based on the net amount accruing to the transferor. If you can see here, we base the computation of interest on the amount accruing to the transferor, which is 87,000 US dollars. We multiplied it by, so sorry, this is just an error, typo error. So the interest should be 15%. Okay, so 87,000 US dollars multiplied by 15%. And take note, the credit terms is for the 30 days. So we multiply 30 divided by 360 days. So we use 360 since in 1 year there are 360 days. Okay, so this is just for the interest period. So the interest for 30 days, 15% is equal to 1,088 US dollars. So basically, the total amount to be received immediately after considering the factor's reserve, the factor's fee, and the prepaid interest, it is 85,912 US dollars. So what is the journal entry for this? So here, if you can see the journal entry, we debit cash by 85,912 US dollars. We debit due from factor, which is 10,000 US dollars. We also debit loss on sale of receivables, 3,000 US dollars, and then we debit prepaid interest, 1,088 US dollars, and then we credit the gross amount of accounts receivables, which is 100,000 US dollars. So if you can note here that 10,000 US dollars is 10% reserve, right? We use the account due from factor because this is still collectible from the factor. It's just that the factor has only withheld this amount. So it's simply a receivable of the company from the factor. On the other hand, the factor's fee, so this is like a service charge for the factoring services. So on the company's point of view, I will not be able to get anything out of this. So I already recognize loss from this. So it's a loss on sale of receivables. It's like a service charge. Okay, so it's like an expense account. So for the interest, we use the account prepaid interest because this entry is actually recognized at the point of factoring, meaning at the beginning of this transaction. So the interest has not yet run, meaning the interest has not yet been incurred. So here is still a prepaid interest, which is 1,088 US dollars. Okay, and then we credit the gross amount of accounts receivable, since we are saying that we are transferring the gross amount of receivables to the factor. Okay, so that ends this lesson. I hope that's clear. Comment below if you have questions or clarifications. My name is Jean. Thank you for watching. If you like this video, hit like, share, and subscribe. Till next time.